All right, so get ready because we're diving deep into cash and due from banks.
Ooh, that sounds exciting.
It is actually. We've got this whole chunk of FDIC guidance on it. And trust me, it's way more interesting than it sounds.
Really?
Yeah, we're going to figure out how banks, manage all their cash.
Okay.
They've got to have enough for us when we need it,
Right.
but also handle all these crazy transactions between banks.
Yeah, it's a tough balancing act, for sure.
Yeah,
Banks can't just have piles of cash sitting around doing nothing.
right. Got to make that money work.
Exactly. It needs to be out there earning some returns.
Yeah,
But, they also got to be ready if everyone suddenly wants their money back.
like a bank run.
Yeah, like a bank run.
Mm.
And of course, they've got to keep enough in reserve to satisfy the regulators.
It's like they're walking a tightrope.
Yeah, got it. One wrong step and their profits tank.
Or worse, they're facing a full-blown crisis.
Exactly.
Mm.
Speaking of which, remember those old bank heist movies?
Oh, yeah.
All that cash just sitting there, ripe for the taking?
I bet security's gotten a lot more sophisticated since then.
Oh, absolutely. It's not just about stopping those old-fashioned robberies anymore. It's a whole new game.
So what's changed?
Well, there's Regulation D, for one. That's the rule that dictates how much cash banks need to keep in reserve. And let me tell you, it plays a huge role in keeping the whole financial system stable. Remember the 2008 crisis?
Oh, yeah.
Well, a big part of the problem was that banks weren't holding enough reserves.
So, like, not enough cash on hand.
Exactly. Not enough of a cushion to absorb those losses.
Makes sense. So let's talk about this clearing process. It sounds like it's pretty central to how banks manage their cash flow.
Absolutely. It's the backbone of the whole system.
But when I hear clearing, I picture, like, mountains of checks being sorted by hand.
Ah, the good old days, right?
Is that still a thing?
Well, the image isn't totally wrong, but it's definitely evolved.
How so?
It used to be all about those local clearinghouse associations. Couriers would physically transport checks between banks. Can you imagine? But now it's all about image capture, electronic transmission, and even remote deposit capture.
So technology's taken over.
You got it. It's been a remarkable transformation.
So instead of checks taking a slow boat across town, it's all digital and instant.
Pretty much. It's light and fast compared to the old days. But here's the thing. Even with these super efficient systems, the role of checks is shrinking.
Really? Why is that?
Well, think about it. We're all using electronic payments more and more.
Yeah, tapping cards, online banking, those peer-to-peer payment apps.
Exactly. It's just so much easier and faster.
Makes sense. But what about those few checks that are still out there? What happens to them?
That's where cash items and due from accounts come in.
Okay, break those down for me.
A cash item is basically a check or other instrument that's in the process of being collected. It's like a temporary IOU until money actually settles.
Gotcha. And due from accounts.
Those are like running tabs between banks. They keep track of all the money that's in transit for different transactions, everything from basic check clearing to more complex stuff like loan participations or those federal funds transactions.
So it's like this constantly updating ledger, tracking who owes what to whom in this giant whirlwind of bank transactions.
You got it. That's a great way to visualize it. And to make things even more interesting, you got things like compensating balances.
Compensating balances, what are those?
It's where some banks require other banks to keep a minimum balance in their accounts, like a payment for services,
Services.
like check processing or participating in loans.
Interesting. Doesn't that create some opportunities for, let's say, creative accounting?
Oh, absolutely. It's a potential minefield.
I mean, couldn't a bank officer potentially, use those relationships for personal gain?
You're sharp. That's a real risk. We'll dig into that later when we talk about bank examiners and due diligence. But first, let's talk about some cool instruments banks use.
Okay, like what?
Deposit notes and structured CDs.
Ooh, fancy.
Right. Deposit notes are kind of like CDs, but structured more like bonds.
So banks are lending money to each other.
Exactly.
Yeah.
Often for longer terms than your typical CD. It's a way for them to manage their long-term liquidity needs while also making some interest.
Smart. And structured CDs. What makes them special?
Their returns are often linked to different market indices.
So they're like riskier CDs.
Yeah, basically. Higher potential returns, but also higher risk.
Yeah.
Imagine a CD where the return's tied to how the stock market performs.
Oh, I see. So it's like a gamble.
In a way, yeah. It adds a layer of complexity and risk.
Wow, this is starting to feel like a financial thriller. Banks juggling cash, sending payments back and forth at warp speed, and dabbling in these, like, potentially risky investments.
It is pretty exciting when you think about it.
It makes you wonder, who's keeping an eye on all of this?
That's where the unsung heroes of the financial world come in.
Yeah.
The bank examiners.
Cool.
Bank examiners, think of them like financial detectives. They scrutinize a bank's cash and due from accounts to assess their financial health.
Okay.
And most importantly, their liquidity.
So, like, making sure they have enough cash on hand.
Exactly. They're making sure banks aren't getting too cozy with each other or taking crazy risks that could jeopardize the whole system.
Got it. So it's not just about the numbers on a balance sheet. It's about understanding these intricate relationships between banks and making sure there are safeguards in place.
Exactly. It's about protecting the whole financial ecosystem from those who might be tempted to take advantage.
Makes sense. So how do they do that? What tools do they use?
Well, one key concept is interbank liabilities. That's basically the money a bank owes to other banks.
Okay.
Regulators like the Federal Reserve have rules to limit how much exposure any one bank can have to another. It's like preventing a domino effect.
So if one bank goes down, it doesn't take everyone else with it.
You got it. They
Yeah.
call that systemic risk,
Yeah,
and nobody wants that.
I can imagine.
Yeah.
So what are some of those rules?
Well, there's Regulation F, for example.
And what does that do?
It's designed to manage the risks associated with correspondent banking.
Correspondent banking.
Yeah, that's when banks have relationships with each other to provide services.
Okay.
Regulation F focuses on credit risk, liquidity risk, and even the operational aspects of these relationships. It's all about ensuring stability.
Makes sense. But what about situations where things still go wrong? Like, what if a bank gets overly reliant on just one other bank? What are the risks there?
That's a great question. And it leads us to the concept of correspondent concentration risk. It's all about diversifying your relationships.
So don't put all your eggs in one basket.
Exactly. Spreading the risk is key.
Okay, so even with all these regulations, banks still need to be careful about who they partner with.
Absolutely. They need to manage those relationships very carefully to avoid unnecessary risks.
So what are some of the red flags that examiners look for when assessing a correspondent bank? Like, what are those warning signs that things might not be as great as they seem?
Well, there are a few key things. One is a deteriorating capital ratio. Capital is basically a bank's buffer against losses.
Okay.
So if those ratios start to slip, it could be a sign of weakness or excessive risk-taking.
Like a canary in a coal mine.
Exactly. It's a warning sign that things might be heading south.
What else do they look for?
Another red flag is an increasing level of other real estate owned. We call it OREO.
Oreo, like the cookie.
Yeah, kind of. But in this case, it's not so sweet. It usually happens when banks foreclose on properties and end up stuck with those assets.
Oh, I see.
A lot of OREO on the books can signal trouble in the loan portfolio and potential losses down the road.
So like a bank ending up with a bunch of houses it can't sell.
Exactly. Definitely not a good sign.
So it sounds like examiners are super important for keeping the banking system healthy.
They are absolutely essential.
But it also highlights that banks themselves need to be careful and manage their risks, especially when it comes to who they work with.
Couldn't agree more. It's a shared responsibility.
Okay, so we've covered a lot of ground here. We've talked about the challenges of managing cash, the amazing evolution of the clearing process, those unsung heroes, the bank examiners, and the importance of not being too reliant on any one partner bank.
We have covered a lot.
It's clear that understanding these complex relationships between banks is key for grasping how the whole financial system stays stable.
You nailed it. It's not just about individual banks doing their own thing. It's about how they're all connected and how those connections can either spread risk or contain it.
Right, it's a whole ecosystem.
Precisely. A delicate balance of cooperation and competition.
But before we get lost in the weeds of risk management, let's take a step back and think about how banks can actually manage these correspondent concentration risks. They can't just stop working with each other, right?
Of course not. Correspondent banking is vital for so many essential services.
Right, things like check clearing, wire transfers, moving money internationally. It's all part of the global financial network.
Exactly. The key is to manage those relationships wisely and avoid becoming too dependent on any single institution. Diversification is key.
So don't put all your correspondent eggs in one basket. Makes sense. What are some practical things banks can do to mitigate these risks? How can they make sure they're not overly exposed to any one correspondent?
Well, one of the most effective ways is diversification.
Diversification.
Yeah, instead of relying on just one or two correspondent banks, they've spread their business across a wider network.
Okay.
Kind of like diversifying your investments.
Oh, right. Don't put all your eggs in one basket.
Exactly. Reduce your exposure to any single point of failure.
That makes sense. What else can banks do to manage these relationships?
Well, they can actively try to reduce their exposure.
Okay.
So if they realize they've become too reliant on a particular correspondent,
Uh-huh.
they can take steps to gradually reduce that reliance over time.
So, like, what kind of steps?
It might involve shifting some business to other correspondents, or maybe establishing direct relationships with customers in certain markets.
Oh, so they can bypass the correspondent altogether?
Yeah, in some cases.
Yeah.
Or they might just reduce the volume of transactions with that specific correspondent.
So kind of like weaning themselves off.
Yeah, that's a good way to put it.
Interesting. Are there any other tools in this risk management toolbox that banks can use?
Absolutely. They can also get creative with how they structure their relationships.
Okay, how so?
For example, they might require a correspondent to act as an agent rather than a principal.
Agent versus principal.
Yeah, it's a legal distinction that can limit the bank's financial exposure if something goes wrong.
Ah, so it's all in the fine print.
You got it. Being mindful of those details can really minimize risk.
Okay, that makes sense. But what happens if things really go south? Like a correspondent bank starts showing signs of real trouble. What then?
That's when a solid contingency plan is critical.
A contingency plan.
Yeah, they need a clear plan outlining the steps they'll take if a correspondent bank starts to wobble.
So like a financial fire escape plan.
Exactly. Know what to do if things heat up.
Okay, so what kind of things would be in that plan?
Well, it could involve moving funds quickly to another institution.
Oh, right. Get your money out of there.
Exactly. Or maybe terminating certain services.
So cutting ties.
Yeah. Or taking other actions to protect their interests and limit potential losses.
So it's all about being prepared for the worst case scenario.
Exactly. It's about minimizing damage if something goes wrong.
That makes a lot of sense. But those plans can't just be sitting on a shelf somewhere, right?
No way. They need to be reviewed regularly, updated, and tested.
To make sure they'll actually work.
Exactly. The financial landscape's constantly changing. Relationships evolve.
Right, so you can't just set it and forget it.
Nope. You got to stay on top of it.
So managing these correspondent banking relationships is an ongoing process.
Absolutely. It requires vigilance, being proactive about risk,
Yeah.
and adapting to changes.
Okay, I'm getting that. So it's not a one and done kind of thing.
Not at all. It's about constantly evaluating those relationships,
Yeah.
assessing the risks,
Mhm.
and figuring out how to mitigate them effectively.
And remembering that the whole system's stability depends on everyone doing their part. Right.
You got it. It's a shared responsibility to keep things running smoothly.
Well, I think we've done a pretty thorough job unpacking this whole cash and due from banks thing.
I think so too.
Yeah.
It's a lot more intricate than most people realize.
We've covered cash management, the clearing process, those bank examiners, and all the risks that come with these relationships.
Yeah, we've covered a lot of ground.
And I think we've shown that it's all vital to how the whole financial system works, both today and going forward.
Absolutely. It's a delicate ecosystem where even something as seemingly basic as cash management has these ripple effects.
Right. And the relationships between banks can amplify those ripples.
Exactly. It's
Oh.
all interconnected.
So I hope our listeners are getting a sense of how complex and fascinating this all is.
I hope so. It's a hidden world that most people never even think about.
But it's one that impacts all of us.
That's for sure. Our financial lives depend on it.
Now, before we wrap up, I want to shift gears a bit and look ahead.
Okay.
You mentioned earlier that checks are on their way out, right?
Yeah, they're definitely declining.
As people use electronic payments more and more. So what other trends do you see coming down the pike? How will those impact the relationship between banks and their correspondents?
That's a great question. Technology's changing everything so fast.
Right? It's a whole new world.
We're definitely going to see even more growth in electronic payments.
Okay.
And those paper checks will keep fading away. That's going to have a big impact on correspondent banking relationships.
How so?
Well, as check processing drops off, banks might need fewer correspondents to handle those transactions.
So some of those old relationships might start to fade away.
It's possible.
Yeah.
But at the same time, this move to digital creates new opportunities to work together.
Okay, I see. So it's a double-edged sword.
Exactly. Like banks could partner with fintech companies to develop new payment solutions.
Fintech.
Yeah, those tech companies that are disrupting the financial industry.
Oh, right. So banks are working with their potential competitors.
In some cases, yes. It's a new era of collaboration. They could also explore blockchain technology for settlements.
Blockchain, that seems to be the buzzword everywhere these days.
It is. But beyond the hype, It has real potential to revolutionize how banks interact, streamlining and securing transactions with a shared, tamper-proof ledger.
So like a digital record that everyone can trust.
Exactly. It could cut out the middlemen, speed up settlements, and lower costs.
That sounds amazing. Like imagine international payments happening instantly without those crazy fees.
Yeah, that's the vision. But, of course, there are still challenges to overcome.
Like what?
Cybersecurity is huge. As more transactions move online, the risk of cyber attacks and data breaches skyrockets.
Makes sense. More digital transactions mean more opportunities for hackers.
Exactly. Banks need to invest heavily in security if they want to protect their systems and their customers' data.
So like building a fortress around all that digital cash, what else is on the horizon?
Well, keeping up with regulations will be a challenge too.
Oh, right. The rules are always changing.
They are. As new technologies emerge and markets evolve, regulators need to adapt to keep things stable, protect consumers, and encourage innovation without things getting out of control.
Sounds like a tricky balancing act.
It is. Banks need to be agile and responsive to keep up.
So they need to innovate and adopt new tech to stay competitive, but also operate within this complex and constantly evolving regulatory landscape.
It's not easy. Finding that balance will be key to success in this new era of banking.
It sounds like we're entering a whole new phase of banking. Traditional boundaries are blurring, lines between banks and other financial players are getting fuzzy, and the pace of change is through the roof.
You're absolutely right. It's a time of great opportunity and potential disruption.
So who will come out on top?
Those who can adapt, innovate effectively, manage their risks, and stay ahead of the regulatory curve.
It's like a whole new game.
It is, one with completely new rules.
So what does this new financial ecosystem look like?
It's more fluid, more interconnected. Collaboration and competition are both going to be crucial.
Makes sense.
Banks will need to be nimble, adaptable, and willing to partner with all sorts of players. Fintechs, tech providers, even potential rivals.
Wow, that's a lot to wrap your head around.
It is. But it's also incredibly exciting to be a part of this transformation.
Well, this deep dive has certainly been an eye-opener for me.
Me too. It's amazing how much we've uncovered.
We started with the nuts and bolts of cash management and ended up contemplating the future of banking in this rapidly changing world of technology, consumer behavior, and regulations.
It's been quite a journey. I hope our listeners are feeling just as energized by this as we are.
I'm sure they are, and I think we've given them plenty to think about. But before we sign off, I want to go back to our source material for a minute. Is there anything from the FDIC's guidance that we haven't really touched on yet that you think is worth highlighting?
You know, we didn't really talk about the importance of due diligence when establishing these correspondent relationships.
Oh, right. Due diligence. That's that whole process of thoroughly vetting potential partners, right?
Exactly. The FDIC is really clear on this.
Okay.
Banks need to take it seriously.
I can imagine. So it's like doing a background check before you get into business with someone.
Exactly. When it comes to correspondent banking, due diligence is absolutely essential.
Okay, so what does that involve?
Well, they need to go beyond those fancy brochures and presentations.
Right, don't just take their word for it.
Nope. They need to carefully assess the financial health, operational capabilities, and reputation of any institution they're considering working with.
So it's about understanding the risks involved and making sure you're comfortable with them?
Absolutely. It's about making informed decisions.
So what are some of the key areas they should focus on during due diligence? What are those red flags that might signal a potential partner isn't a good fit?
Well, for starters, they should carefully scrutinize the potential correspondent's financial statements.
Looking for what?
Any red flags that might point to financial weakness, excessive risk-taking, or maybe questionable accounting practices.
So it's like a financial health checkup.
Yeah, basically. Are their capital ratios strong? Are they consistently making profits? Are there any signs of trouble in their loan portfolio? These are all critical questions.
Okay, so they're really digging deep. What else should they be looking at?
The management team is important too.
Okay.
Their experience, their reputation, their overall approach.
So not just numbers, but the people running the show.
Exactly. Are they competent, ethical, committed to sound business practices? Do they have a solid track record? Do they seem to prioritize compliance and risk management? Those are all big factors.
So you're not just partnering with a company, you're partnering with people.
Absolutely. It's about trust and shared values.
What other aspects of due diligence are important?
Don't forget the regulatory compliance record.
Oh, right. Have they been playing by the rules?
Exactly. Have they had any issues with regulators? any outstanding enforcement actions, unresolved problems that could come back to bite them.
So it's like checking their regulatory history for any skeletons in the closet.
You got it. It's all about making informed decisions.
Sounds like due diligence is quite a process.
It is, but it's worth it. Better safe than sorry.
So once they've done all that, are they good to go? Or is there more?
It's definitely not a one-and-done thing. Ongoing monitoring is crucial.
Ongoing monitoring.
Yeah, they need to keep tabs on their correspondence.
So make sure things are still running smoothly.
Exactly. Keep an eye on their financial health, their operations, and their compliance with all the regulations.
Okay, so what does that involve?
Well, it might involve regular reviews of their financial statements,
Uh-huh.
maybe some periodic on-site visits.
Oh, so they actually go and check things out in person.
Yeah, it's good to get a first-hand look at their operations.
Makes sense.
And, of course, there's ongoing communication with the correspondent bank's management.
So staying in touch, keeping those lines of communication open.
Exactly. It's all about being informed.
So it's really about maintaining that relationship, making sure things are still good.
Absolutely. And realizing that things can change, so banks need to be proactive about spotting those changes.
It's like tending a garden, right? You've got to nurture those relationships, keep an eye out for any weeds, and deal with problems as they pop up.
I love that analogy. It perfectly captures the ongoing nature of these relationships.
So it's about vigilance, paying attention to detail, and managing risks.
You got it. Those are the keys to success in correspondent banking.
It sounds like it's a balancing act. Banks need to take advantage of these relationships,
Right.
but also be aware of the risks.
Exactly. It's about finding that sweet spot between efficiency and prudence.
Recognizing that these relationships can be super helpful, but they also need careful management.
You nailed it. It's a balancing act, but it's one that banks need to master.
If they want to play in this complex financial world.
Absolutely.
Yeah.
It's the only way to stay safe and sound.
Well, I think we've really done a deep dive here.
We have. It's been quite a journey.
We've explored all the ins and outs of cash management, the evolution of clearing, the vital role of those bank examiners, and the importance of managing those correspondent relationships.
Yeah, we've covered a lot of ground.
And it's amazing how interconnected everything is,
It really is. It shows how complex the financial system is.
and how much it impacts all of us.
That's for sure. It's the backbone of our economy.
I think we've also given our listeners a lot to think about when it comes to the future of banking, especially with technology changing everything so rapidly.
Absolutely. It's a time of great change, but also great opportunity.
So what do you think the future holds?
That's a tough one. But I'm optimistic. I think we're going to see some really innovative solutions emerge.
New ways of doing business.
Exactly. Ways that benefit both banks and their customers.
Okay, so one last thought before we wrap up. You mentioned earlier the importance of the human element in these relationships.
Yeah.
It's easy to get caught up in all the technical stuff, the regulations, the technology, but in the end, it's still people dealing with people.
That's so important. You can't forget that.
So how do you build strong relationships in a world that's increasingly digital?
Well, it's about making a conscious effort to connect on a personal level.
So more than just emails and spreadsheets.
Exactly. Pick up the phone, have a video call, meet face-to-face whenever you can.
Oh, right. Those personal interactions really do make a difference.
They do. They build rapport, create trust, and make it easier to work together,
Mm.
especially when things get complicated.
So it's about combining those old school relationship skills with all the new technology.
Absolutely. Using tech to enhance those connections, not replace them.
So how can banks actually do that? How do they cultivate these personal relationships in this digital age?
One way is to prioritize those face-to-face interactions whenever possible.
Okay.
Industry conferences, site visits, even video calls. It all helps.
So getting out from behind those computer screens.
Yeah, it's about connecting as human beings.
What else can they do?
Create a culture of open communication.
Open communication.
Yeah, both internally and with their correspondent partners.
So encourage people to speak up, share information.
Exactly. Ask questions, raise concerns, challenge assumptions, create a safe space for honest dialogue.
So everyone feels comfortable speaking their mind, even if it's not always positive.
Exactly. That kind of openness is essential for catching problems early, working together to solve them, and building real trust.
It's about recognizing that everyone has a role to play in keeping the system healthy.
Absolutely. We all have a responsibility to act ethically and responsibly.
It sounds like it's a shift in how we think about these relationships.
It is. It's about more than just transactions and profits.
It's about building strong, resilient partnerships based on shared values and a commitment to success for everyone involved,
You said it perfectly. It's about recognizing that we're all in this together.
working towards a common goal.
Exactly. Building a more stable, resilient, and trustworthy financial system.
Well, I think we've really come full circle here.
I think so too.
We started with the nitty-gritty details of cash management and ended up talking about the importance of human connection in this digital age.
It's been quite a journey.
It really shows how complex and interconnected everything is.
And how much the human element matters.
Absolutely. But before we say goodbye, I want to leave our listeners with one last thing to think about.
Okay.
In this increasingly interconnected world where technology is changing the game and everything seems to be moving faster and faster, what will it take to build a better banking system?
Wow, that's a big question.
It is, but it's one worth pondering.
Absolutely. It challenges us to think about the role of banking in our society.
The values it's built on.
Right. And the choices we make,
Hmm.
individually and collectively, that shape the future.
So, what kind of financial future do we want? And how do we get there? Those are questions we all need to grapple with.
I agree. It's a conversation that needs to happen.
Well said. And if you're interested in diving deeper into this topic, be sure to check out the show notes for links to that FDIC document and other resources. They can help you explore this fascinating world of banking in more detail.
There's a lot to learn.
There is. And it's always changing. But that's what makes it so exciting. Thanks for joining us on this deep dive into cash and due from banks. We hope you found it informative and thought-provoking.